Welcome to this Fidelity International client call, where we'll be discussing the latest Analyst survey. And this one is quite a special one. It's only the second time that we have devoted an entire round of questions to sustainable investing. We've had responses from 161 analysts from around the world who specialize in equities or fixed income, or in some cases, both. We aggregate their insights on how investee companies are behaving, and we can begin to see patterns emerging across regions and sectors. Now, to discuss the findings, I'm joined by an all-star cast of Fidelity experts. Geeta Bao is our head of research for fixed income. Fiona O'Neill, head of strategic initiatives for the global research team. Jen-Hui Tan joins us from Singapore. He's the head of sustainable investing, and in charge of the whole research operation around the world is Ned Salter. And we'd like to include you, our clients. You should see at the foot of your Zoom screen the option of asking questions. Please do send in your thoughts and I'll put them to our panel. Feel free to send them whenever and I'll try to pepper the conversation with them as we go along. It could be something that's emerged from the survey, or you might have a question about how Fidelity approaches an aspect of ESG investing, or it could be a question about sustainability in the wider world. We're here at your disposal for the next 43 minutes or so. So let's get on with the survey. And Ned, before I get into the detail, can you give us an overview of why we run these surveys? I think it's worth highlighting that it's now routinely mentioned in briefings by the investment team, including by our CIO. So what are its credentials?
So we're really proud of that, Richard. And I think, there's a lot of value that gets added to investment processes by thinking about the world from a top-down perspective. But one of the benefits of our approach here at Fidelity is that we have an unbelievable amount of resource that considers issues around our investee companies and markets from a bottom-up perspective. And so, as you mentioned, we have about 160 analysts around the world participating in this survey, as we do each month, or as you've said, each year in our analyst annual sustainability survey. And what really makes it unique is that our analysts are meeting with companies something around 15,000 times a year in management meetings. They are in constant contact with investee companies, but not just with the companies themselves, with everyone related to those issuers' ecosystems, so customers, suppliers, and the employees themselves in certain cases. And that gives us a great lens by which we can analyze these organizations. We can consider the issues of revenue and their cost structures and make sure that our financial analysis is correct. But I would also be remiss if I didn't point out that our investment analysts are also the ones responsible for undertaking the sustainability analysis of the issuers themselves. And so it really gives us a perspective from capital deployment as we think about issues around sustainability. So it's been a great opportunity for us to really harness the power of the platform. And that's why we run the survey so frequently.
And they really do bring together some interesting insight around the world. Core to all of this, there's that 15,000 contacts that you talked about every year, Ned. Within that is the engagement, the discussions that Fidelity's analysts have with company management teams. So Jen, what is the aim? Can you briefly explain what it is that these analysts are trying to do each time?
So thank you for starting with a softball question, Richard. I'm sure they'll get a bit tougher.
I'll do my best.
So this is a pretty straightforward one. I think it gets summed up one phrase, which is long-term value creation. We are ultimately active stewards of our clients' capital. Our core responsibility, our fiduciary duty to our clients, is to protect their capital and enhance it over the long term. And that's really what we aim to do with engagement. We want our companies to be run in a sustainable way because we believe that is how you create sustainable long-term value. And that is what our analysts are out there trying to do, ensuring that we are sharing our best practices, our knowledge across different sectors and different geographies, and bringing that to the management team in a spirit of partnership to help them to achieve their goals.
Thank you. And a note to our clients watching this, any difficult questions, please mark them for Jen's attention and I'll pass them on. Now, the themes that the team...
Can I interrupt on this point, Richard? Because you did reference the 15,000 company meetings, and I think it would be remiss if I didn't add on to Jen's comment, is that we don't consider every management meeting an engagement itself. And I think that's an important point that we need to differentiate. An engagement, there's this a pretty clear definition by the UNPRI on what constitutes an engagement, but certainly and engagement is a subset of those meetings where we're really focused on a particular E, S, or G topic that, as Jen says, allows us to help sort of bring that fiduciary duty to bear and help move those organizations through their kind of corporate life cycle.
Okay, thank you. Good point. Geeta, let me move to you then on those E, S, and G themes. What are they? Which are the ones that the analysts are telling us are cropping up the most, that they're leading on, and how has that changed over the past year?
Thanks, Richard. I think it will come as no surprise that the two topics that are most interesting to analysts right now within this space are governance and greenhouse gas emissions. Governance, though, if we had asked analysts 10 years ago, that's what they thought engagement was about. So it's always been front and center of what our analysts did, whether fixed income or equities. Greenhouse gas emissions really shows you the scope of how people are really focused on the climate crisis now. But I think what gives me the greatest hope for the future is when we've asked analysts, what are you going to engage on next year, or this year in 2022 and the next 12 months? The range of topics that are of interest to our analysts is just growing. So it's questions of employee welfare, questions of diversity, geopolitics is coming up now. And I think probably the one that gives me the most heart, and Jen as well, is that biodiversity, from really not being on most analysts' radar screens just a few years ago, is quickly leaping up the importance, and people are starting to ask those kinds of questions as well.
Jen, I know that you and the team of the sustainable investing team, have put a big focus on biodiversity this year. Why have you picked that out?
So, our biodiversity is reducing faster than any time in human history. Our current extinction rate is anywhere between 1,000 to 10,000 times higher than the natural rate. Things like clean air, clean water, stable habitats, pandemic-free communities, these all depend on a healthy and diverse bioecosystem. The World Economic Forum has ranked biodiversity as a severe risk to humanity over the next decade. And so, armed with that, we chose deforestation as one of our key priorities in 2022, because we think it is critical to both reducing climate change, because they are huge carbon sinks, the forests, and also protecting the world's biodiversity. And really, reducing these emissions is only part of the battle. We are going to need to actively remove carbon from the atmosphere if we stand a chance of meeting all of these targets. The other main reason why we chose this is because we as a firm have made pledges and commitments to ourselves and to the broader community. At COP26, we made a pledge to eliminate agricultural, commodity-driven deforestation from our investment portfolios by 2025. And that puts a very strong emphasis on our thematic engagement programs with the relevant commodity businesses of palm oil, beef, soy, and paper and pulp. We've also joined the Natural Capital Investment Alliance, which aims to mobilize more than $10 billion by the end of this year into investment products aligned to natural capital.
And what do you expect of the companies? What changes are you and the team asking for when meeting them on this particular theme?
So I think it's important to not just think about the problem of biodiversity is a value chain problem. And it needs to be treated as such. So only looking at the commodity producers and saying, you need to tackle this by ensuring that you have sustainable farming and removal practices is only one piece of it. We need to go down the chain, all the way down to the retailers and the consumers ultimately. And we need to link up all of these pieces. And I think that's where the strength of Fidelity's research platform really comes through. Because of our expertise at all of these different points of the value chain, we can set targets that are appropriate to that company's business within the context of its value chain. So it's not just saying deforestation is a big issue, you guys really have to pay attention to it. It's about thinking about a tailored conversation with that business, what they can do from their vantage point to address this issue.
So within that framework, you've got a theme, you've got an approach to the company management team that you're targeting. Fiona, how much influence can an analyst representing Fidelity have over a company when they do meet and have these conversations?
Yeah, pretty big influence actually. And when we've talked to our analysts, you know, and we've talked to the companies too, what we're hearing is that this engagement from us and others is really second only to government action when it comes to driving environmental change, driving environmental practices. And on a global basis, through this survey, what our analysts have told us is that investor engagement trumps consumer action, shareholder resolutions, divestment, you know, when it comes to really making progress on all of these topics.
You mentioned divestment. That's an important point. Ned, Fidelity hasn't ruled out divestments, but it's not the first step, is it?
No, it's a good question. And I think there's a few different dimensions to the concept of divestment. There's divestment of assets from within our investee companies' portfolios. And that's something that we could have a hotly contested debate about, which I think is very interesting. But I think what you're referring to, Richard, is Fidelity's divestment of securities from our portfolios. And I think Jen's introductory comments really just reiterate the point that from our perspective, Fidelity's taken a process where we favor engagement over exclusion. And it's not a throwaway comment. You know, this is something we've been focused on for years. And I really fundamentally believe that we have taken the right strategy, because the evidence would suggest that exclusion-oriented processes don't raise the cost of capital for issuers, that there is always someone standing by ready to buy a security if it's cheap enough. And so the perspective that we've taken is one where we endeavor to foster change through engagement over time. However, there has to be the opportunity to call time on a series of engagements with issuers if and when they are unsuccessful. And so at that point, I do think it is relevant where our investment professionals and our sustainability professionals have taken the decision that our engagement activities are not being successful, quantitatively measured. There comes a point where those securities need to be divested from the portfolio, and it's not something that we're against by any stretch of the imagination.
So that's a sanction, that's the ultimate sanction. But beforehand, a lot of engagement is going on. Back to the survey, Geeta. We've been monitoring who the analysts are talking to, because I think there's a picture emerging there of sustainability being taken more seriously by the investee companies, the issuers. So what's the pattern?
So around half of our engagements now are at a C-suite level. That's 49%. And I think really hearteningly, that's up 5% just on a 1-year view. And I think this is because if we're really going to make a dent in sustainability, we need to lead companies from the top. And if it's that C-suite that is sitting there and thinking about how can we embed sustainability into our financing plans, into our operational plans, into our overall strategy, that is a much more powerful route to change than if it is just the investor relations or the sustainability team talking about these issues.
And we're talking about listed companies at the moment, but it doesn't just stop with equities and fixed income.
That's absolutely right. I think, and look, even our fixed income analysts, they're engaging with companies that don't have listed equity, that maybe aren't having a conversation about this with a lot of other investors. I think there's definitely a role in other asset classes. There's a role in private markets, notably real estate, in private credit. And I think it's up to us as investors in all of these asset classes to really see how can we best engage and what are the mechanisms that we can use to drive change.
Okay, we are getting some questions coming in. Thank you very much indeed for these. So the first one is, what's your view on the transition potential of large oil and gas companies, for example, in the United States? We're going in there for the jugular, the companies with possibly the worst label at the moment. Jen, let me put that one to you.
Gosh, I was really hoping that you wouldn't do that. So I don't think it's fair to just pick on the US. I think that the transition of oil and gas needs to happen much more broadly. I think you can point to a greater level of awareness, but I think US oil and gas majors are equally in need of that transition, and not just any transition, I should say, but a just transition as well. So what happens to those workers and communities that are affected by the move of those? And so that's part of what we're focusing on. If I think about kind of, what the need is, I think we need to kind of be a bit more thoughtful about thinking about the different types of oil and gas players out there and designing different transition plans for those different. So how we would treat a shale player would be quite different from how we would treat an Arctic miner, for example. And I think we need to kind of recognize those individual nuances as well. I think we also need to acknowledge that within the global economy, there is going to be a role for oil. Some estimates will say up to 40% of the world's energy by 2050 should still come from some oil in some shape or form. So this is not a case of demonizing the industry, and this is not a case of saying that it can't exist. What it needs to do is enhance its practices to reduce its Scope 1 and Scope 2 emissions at the point of extraction, and then work around how the energy needs, the future energy needs, and the incremental energy needs are met by alternative energy sources, not from these traditional ones.
Ned, do you want to pick up on this?
There's a great saying that a lot of energy investors use, which is the cure for a high oil price is a high oil price. And I think what it means is obviously that when oil prices are high because of either demand or supply, excess demand or supply constraints, that triggers people to go out and invest in exploration and production, which increases the supply, which lowers the price. And I know this is very topical right now because energy is moving higher at a time when we're all focused on sustainability. But I think the general view is that this cycle is going to be different, that all else being equal, high oil prices right now have just made the relative ROIs on alternative fuel sources look more attractive. And so I think the market is sending a great signal right now. And I do think that you're going to see an acceleration of alternatives at this point in the cycle, notwithstanding a supply chain bottlenecks that may exist at certain parts within that alternatives ecosystem and supply chain. But I do think when we look back on this moment in time, we will realize that companies' behaviors did pivot this time.
Okay, changes in the air and in the ground. Geeta, let me come to you because you mentioned private companies, and we have another question that's come in saying, how do your analysts engage with private companies? Can you give an example? Because it's quite a different relationship, perhaps, than if you're doing this through assets that you own in markets.
I actually don't think it's that different. And I think where this has really emerged is kind of our philosophy. Our analysts have always teamed up. We've never kind of viewed ESG as belonging to any one asset class. And so when we've looked at it, we've always looked at it hand in glove, our fixed income analyst with our equity analyst, with the responsible member from the SI team kind of working together in partnership to look at companies. And so as a consequence, our philosophy, and mine as a head of research, was always, it's not any different. And you need to go and have a conversation, and that's where it started with, for example, our listed debt companies. So there are companies that are owned often by private equity, but sometimes by family owners who have listed debt. And we kind of said the same things to them that we were saying to our listed equity companies. And what that fostered was kind of this environment where we could think about ESG in a very consistent manner across all asset classes. And now what we've seen is in the more private markets, like private credit, like bank loans, those things, we're taking that same exact philosophy and having the same types of conversations with the management teams, but perhaps with more levers to pull. So for example, if you are working on a bespoke private transaction, you have more levers to pull in terms of documenting what a company can actually do in terms of sustainability commitments that may not be available in public markets. So there's a real opportunity to kind of take that learning and say, well, what can we do in this asset class? Similarly, our real estate team is working really hard with the tenants that let their buildings to say, how can you improve your sustainability metrics using that kind of lens of, we know what good looks like from a corporate point of view. So I think that's just taking our core philosophies and extending them as appropriate and ambitiously as we can into other asset classes.
Right across the field. Okay, lots of good questions coming in. Another one here saying, in addition to Analysts, because this is the Analyst survey, so we've been reflecting on the picture that they've been telling us. Can you give us examples of your portfolio managers engaging? Who'd like to pick that one up? Looks like Ned is reaching for his mic. Oh, no, sorry, Jen. Yeah.
Well,
yeah.
I think we can have two examples.
After you, Jen.
So look, I should as I say, look, I think our analysts don't engage by themselves. They engage along with a broader team, which includes the portfolio managers, that the owners of that stock. One example that comes to my mind is engagements that we've been doing around the gig economy, particularly with delivery platforms in China. I think there's been a growing appreciation. This is partly triggered by regulation, but also changing consumer preferences here. The gig economy has expanded very significantly. We know that over the last 5 years. The number of workers in Asia that are now gig economy workers has essentially doubled. They sit in a, let's call it, murky legal status. They don't have tax and social security benefits, and there have been some very high-profile accidents, particularly for those who conduct on two wheels because of that. And in response to that, governments have been putting more and more regulation, I think led actually by China, the US, and Europe, around the rights and the entitlements of gig economy workers. And in turn, we've been engaging, I say we, our portfolio managers, have been engaging closely with these companies to understand how these changes are being met and how they're being implemented in the right way that preserves the long-term sustainability of these business models. Because I don't think we should ever forget that a delivery platform business depends on these workers to conduct their business. So these are the most important stakeholders that these businesses really have.
Okay, Ned, is there anything that you can add to Jen's eloquent exposition there on the topic? I think what would be helpful would be, some examples of the types of discussions, or even just bringing to light. You talked there, Jen, about the team approach. So, what's going on there? What are the discussions like?
Yeah, so practically speaking, there was an organization in the US, an investee company that had this was not related to the environment. This was much more related to the way that the employees within a particular organization were treated. And we ended up taking a very different view from the board to the remedial actions that needed to be taken within the organization. Into how we could try to create for that organization a better working environment for its employees. And that engagement was led by one of our portfolio managers with a particular expertise in technology. It was a technology related business. But I think, just to echo the way that Jen kicked it off, is that no one engages in isolation. So the meetings that took place with that issuer took place between a portfolio manager, the analyst that was responsible for making a recommendation on that security, a member of Jen's teams whose specialism is digital ethics, for example, as well as one of our senior governance advisors. And so it really was a community of people squaring off with the board of the issuer. So again, it's kind of a community related activity, to echo what Jen said.
Yeah, not just within Fidelity, because there is often collaboration with other asset owners. And Jen, can I come to you on that? Because we asked the analysts which form of engagement is most effective. And I know that there was a big leap in China in cooperation with other asset owners becoming much more effective. Can you add a little bit more detail there?
So, if I think about what makes an effective engagement, whether it's collaboration or one-to-one, I think the important thing, the common thing that all effective engagements have is that they understand the business and they understand the drivers of those businesses. And you are able to cite the engagement advice you're providing in the context of what the company is trying to do. Funnily enough, nobody enjoys being lectured about the importance of abstract topics without a clear understanding of what that could mean to that business itself. Corporate CEOs are no different from any of us. So that's kind of the heart of our engagement philosophy: understand the business, understand the drivers, and then do your engagements. I think specifically in terms of collaboration versus one-to-one, look, obviously it depends on the company, it depends on the region, it depends on the topic. I think things that are more sector dependent, things that have common material issues like climate change or deforestation or modern slavery, collaborative engagements can be more efficient because they provide a common knowledge building platform for both investors and for companies, and they can then leverage the public attention to drive that kind of more systemic level change. One-to-one engagements we find are generally more effective when you deal with either higher profile companies who may not enjoy to have their laundry aired quite so publicly, or in addressing more sensitive issues that are specific to a company's individual culture or structure.
So you've got to tailor it to the individual company. I guess that's where the expertise comes in, of knowing these companies back to front. Geeta, I'd like to pick up with you on another question that's come in from people watching this, saying, should we be concerned about greenflation? Do you want to explain what it is first, and then whether we should or shouldn't be concerned?
Greenflation, the way that we refer to it, refers to an increase in inflation as a result of the transition to a greener, more sustainable environment. And I think, should we expect greenflation? Absolutely. It is going to come because we need to make these transitions as we, the same quote that Ned made about like the best cure for a high oil price is a high oil price. I think it applies in this case too, is that we should expect that better technologies are going to be more in demand, and therefore we are going to see sources of inflation from both the investment and from the driving towards this change. However, should we be afraid of it? Absolutely not. This should be giving us hope, right? Because we don't have an alternative to doing this. The alternative, the costs of greenflation are far lower than the costs of a, above 1.5 degree climate change. They're much lower than the costs of a mass extinction event. So I think that we just need to keep this in perspective. We don't have a choice. We are going to have to accept some short-term costs in exchange for a long-term, more sustainable planet.
And there is a flip side.
Can I just add a quick,
Yes, Jen.
Can I just add a quick sort of data point to Geeta's excellent commentary. Swiss Re has estimated that by 2050, if climate change is left unabated, we will lose $23 trillion a year in output. So whatever you think the cost of spending on infrastructure and technology and mitigation and adaptation activities is, it's not more than the cost of not doing anything at all. So there is no BAU path here. And I kind of just want one extra comment, because I think it's a subject I feel very passionate about. I do not think our energy system today is adequate for our needs as an economy and as a society. It is unaffordable, it is inaccessible, it is unreliable, and it creates significant geopolitical risks for us as a planet. Now, whatever you think about the cost of transition, renewable energy has one quality, which is that it tends to be domestically available. Wind and sun are everywhere, hydrogen is all around us. If we can transition our energy grid to these more sustainable sources, we build not just a more sustainable energy system, but we provide energy security to those individual nations as well.
There is an upside to this as well. It was one of the questions in the survey about risks and opportunities from the transition to net zero, which is that many companies may well do all right out of changing to meet those new demands. Fiona, is there anything that you can add on that? Because there were some regional differences of companies where our analysts thought they were more optimistic than others.
Yeah, so one of the regions where they were much more optimistic, for example, was in Japan. And that really stood out from the survey.
Things like semiconductors and so on. Okay, all right, well, let's take another question now. We've got one here. What is your view for clients' route to net zero through their investment allocation? How should clients be allocating? Ned, can I come to you first on that one?
I was going to hand that question to Jen. You said all the difficult questions were going to Jen.
Well, we can come to him in a minute, but why don't you give it a go?
So, yeah, I mean, I guess the way I tend to think about the world is actually much more at the security and the portfolio level than from the asset allocation perspective, because I think that's the lens that I've sort of grown up in this business. I think what Jen said is ultimately, I'd give the same answer here, which is that the cost of not achieving net zero is far higher than any costs that we're going to incur, financial costs that we're going to incur along the way. So I think the key thing that we really need to think about from an asset allocation perspective then is really measurement. And measurement is something that I think Jen can talk a little bit about in Fidelity's approach towards measuring the climate activities of our investee companies, because at the end of the day, that's how we construct our portfolios, and that's what asset allocators get exposure to. Okay, Dick. Thank you very much. Jen, do you want to add anything?
Yeah, so look, I think it's a great question. It's something that a lot of our clients are asking us, and we're having some quite active discussions around how we do that. I think one point that emerges in common amongst all our clients is the appreciation that this is a multi-dimensional, multifaceted topic. You want to achieve the right outcomes by treating it in isolation. And actually, you're better off thinking about different toolkits that you can composite together, depending on your investment approach, depending on your active versus passive, and what your TA and SAA allocation styles are, and then building up a process that is appropriate for you as an asset owner. So, for broad buckets, I guess I could say, looking one at the emissions profile of your book, so looking at how it's changing over time, looking at whether it's aligned to a 1.5 degree scenario, looking at the footprint and so on. The second is looking at the individual securities themselves, which is what Ned talked about from a bottom-up perspective. How are they transitioning? And actually, Fidelity has built a tool, the climate rating, that we use to measure the genuineness of a company's ambition and progress towards those net zero targets. The third is around looking at the revenue that is generated that within the individual solutions you could offer towards climate. So looking more at it from a thematic perspective, for example. And then the final piece, the one that we are focused on, engagement. How are you then working with all of these holdings to promote that transition?
So if that's the framework of approaching all of this, and thank you for that, Jen. Geeta, I'm going to put a question to you that's just come in as well, which is taking all of that into account, which asset class, asks our viewer, or sub-asset class can have the greatest impact when engaging, or is it similar? I mean, you sort of touched on this with the private assets, but looking across the field, which is most effective as far as engagement is concerned?
So I think my short answer it's going to be all of them need to be involved in order to drive change. But I guess if you're talking from a pure theoretical basis, if you are an equity owner, you are an owner of that company. If you are in fixed income, if you're in private credit, if you're in other asset classes, you're a lender to a company. Obviously, you have a different level of influence over the decision making of that company in this case. So I think theoretically there's equities has a bigger role to play, and I think that's why we've historically seen more influence from the equity market. But what I would say is that a lot of public equities are very distributed in terms of their ownership. And as a result, that the impact of any one investor gets diluted. And so what we have to do collectively is to kind of suggest to the market, well, this is our philosophy and this is how we're going to apply it in every single asset class. Because there is a role to be played if you are a lender. There is a role to be played if you are a real estate asset owner and you want to have tenants in your buildings. And I think in the absence of kind of a collective approach to sustainability, we won't drive the change that we need to drive, because it needs to be in bank documentation, in green bonds, in kind of shareholder engagement. It needs to be all of them.
Okay, before I move on, anything further to add from anyone else? No, in that case, I'm going to go to another question that's come in. This is related to something we touched on before, and Ned, it was divestments. You mentioned earlier that energy companies need to transition. What's your view on climate investment approaches that exclude these companies?
Yeah, so I as I've said, I'm not of the mind that exclusion is going to help get us to where we need to be. I think the theory of exclusion is that if asset owners or asset managers don't believe in the operations or of an organization, if you divest that from your portfolio, the cost of capital for that issuer rises, making it harder for them to continue to operate, thereby making it more competitive for disruptors to enter into the market. And I think ultimately that isn't a strategy that is most effective. A more effective approach is one of active ownership, where we as asset allocators on behalf of our clients choose the organizations that are in most need of new sources of capital, and we direct that source of capital to those, to the companies that are potentially delivering disruptive technology or adopting technologies that will enable a transition. So I think the job of the asset manager is to match up capital that we are, given on behalf of the asset owners with the investee companies that are in the greatest need. And I think that's how you power change. That's how you power transition.
Okay, Jen, a little bit earlier, Geeta was talking about the different relationship that you have with an issuer, depending on whether you're an investor in the company or you're lending money to them. So you've got different levers to pull there. One way of really bringing this into focus at companies is by linking executive pay to change that the company is affecting. What has come out in the survey this time about that, and again about how effective it is?
So I think the survey is showing that more and more of this is happening, and that more boards are seeing the need to have targets integrated into executive pay. I have a concern though, which is, are these being actually done in meaningful ways? And are we creating the right outcomes through this? And I think, I think of this question actually as being a kind of it's a good summary in a way for a lot of ESG, right? Because if you ask the question, should you include ESG management pay? Of course, why would you not? Sounds like such a great idea. But then dig even slightly under the surface, and you'll start to find that this is actually a much more hugely complicated topic than simply saying, yes, it's a great idea, now everyone get on with it. And it's actually quite complex. So if I can try and sort of unpack some of that complexity a little bit, there are obviously different types of targets that you can have, right? So the one kind of target would be, I guess you could call them table stakes. These are targets around workplace safety, around anti-corruption, around compliance issues. Should these targets contribute to executive pay? Or actually, should executives lose their bonuses and suffer forfeiture if they fail to meet these targets? Yeah, so that's kind of one type of target. Another type of target is the kind of business as usual target, right? You're running the business, you set a target that aligns with essentially how you are already running the business. And here, what you risk is essentially double dipping, right? All you are really doing is padding out executive pay rather than setting meaningful incentives for them to change. And then the final bucket, which is the bucket that really you want to aim for, is strategic objectives. How do you have metrics tied to strategic goals? And before you do that, you clearly need to integrate those ESG issues into your strategy. Otherwise, there's not really any point, right? So what you could end up doing is creating a lot of unintended consequences by measuring the wrong thing. So for example, you incentivize a bank to reduce their carbon emissions. That's great, but actually the bulk of their influence is through their loan book. So why not kind of focus on that? Or you incentivize diversity targets and you take the attention away from creating an inclusive culture. I think these are the unintended consequences that we need to be quite careful of. Unintended consequences are not unique to ESG. Lots and lots of pay structures create them, but arguably ESG is more prone to them because of the multidimensional way in which ESG factors can work to create things that you don't necessarily intend to do.
And perhaps it's still relatively new as an approach, and we're still learning what some of those what nuances and complexities are. Now, Fiona, another question coming here. This is Matthew has sent this in, saying that, do you think that getting to net zero is really receiving the backing and the influence from world leaders that it needs? I suspect from the way that question's been asked that Matthew has a view, but what's yours, Fiona?
Well, let me say what the analysts think. And that is, one of the questions that we asked our analysts was in their confidence in their companies being on track to meet net zero. And I think one of the shocking things to me in the results was that there's not actually been much change at a global level. We've got about 50% of analysts expressing confidence in their companies meeting net zero. But if you then look at the individual regions, there's been a big leap in confidence in China. And obviously what we've got in China is the 2060 government targets that are now there. And, so I think it really does underscore the real need for government backing. And I said earlier in one of my responses that, we talk about engagement, that it is second only to, but it is second to governments and regulation and, really having something driven from the top.
Which is something that has come out in China, for example, where government policy changing has had a big impact on
exactly, and
companies.
Hence, one of the big reasons why we've seen this improvement in the confidence of our China analysts.
Okay, thank you very much. We haven't got long, only another 3 minutes remaining, so I'm going to pass another question on to Geeta that's come from somebody watching. Fidelity has not been active in the green bond space. No funds. Why not, if we're focused on climate? Geeta?
So I think it's a really interesting question. So absolutely correct. We do not have a green bond fund, but we still do invest in green bonds where appropriate for our existing funds, and you will see we have holdings in them. Why don't we have a green bond fund? Why have we historically taken that view, or why have we not been as vocal about our green bonds? Is because, number one, we think that green bonds are a very valuable instrument, but at the same time, the underlying sustainability metrics of the issuer philosophically is what we've been more focused on. So we don't necessarily want to credit a company out there who's issued a green bond when all of their sustainability practices may be more suspect. We want to start with, do we actually believe in the overall sustainability path of this issuer? I think the second thing that I would say about green bonds from a pure investment point of view is that it's not really in keeping with the philosophies that a lot of historic fixed income investors and clients have been interested in the sense that green bonds tend to be issued by a narrow number of sectors. They tend to also be issued largely in euros. And so you get a much more concentrated portfolio by sector and by currency than you would in a more diversified fixed income fund. The final thing that I would say is that there is a greenium in the market that exists. So while green bond issuance has grown exponentially over the last few years, we still have demand exceeding supply explicitly because there are so many funds who are trying to use green bonds as a proxy for a sustainable investment. And so as a consequence, if the same issuer issues a normal plain vanilla bond and issues a green bond, that green bond will trade at a premium to the plain vanilla bond. If we start with the view that we believe in the underlying sustainability credentials of that issuer, why wouldn't I want to get the better return that would be on offer from that plain vanilla bond instead of the green bond? So there is a place for them. We absolutely invest in them, and if our clients want them, we will almost certainly come out with more labeled bond funds in the future. But historically, we've thought that there were probably better ways to express our sustainability view.
Thank you very much. So it's not that we don't offer them, but we offer them in a different way, perhaps. Okay, well, we are at time. So I'm just going to ask Ned briefly to sum up for us. This is the second year that we've run an analyst survey that's focused on ESG. What's the big picture that's emerging for you as you look across the entire range of questions, the trajectory that's emerging perhaps from the survey?
So it's hard to sum up all of the amazing insight that our presenter shared today. And yeah, as you said, this is the second survey, Richard, but in reality, this is a daily existence. This is the life we lead as asset managers. So while it's an annual survey, it's a daily existence. And, I think the key takeaway for all of us really is that the role of the capital markets are changing. We've just come through a period where we were, focused on extracting the last marginal dollar of economic rent or profit. And I think ultimately, I think we've all agreed that the system itself needs to be enhanced. I'm not suggesting that we are sacrificing financial return for total social return. I'm simply saying that in addition to governments, which I think we've talked about today, in addition to the preference of the asset owners, which of course have one of the most important seats at the table, the asset manager itself has a role to play and an obligation to divert capital to the organizations that are going to help us make the social and environmental changes that society requires. So I think we need to think about the role of the asset manager, and it's something that weighs heavily on our mind. And our colleagues have talked a lot about the activities that we're engaged in to try to fulfill that obligation.
Thank you very much, Ned. Great summary. So we are slightly over time now, but thanks for watching. We've been watching Ned Salter, Geeta Bell, Jen Town, and Fiona O'Neill. My thanks to them and to you for listening and watching and for sending in such thoughtful questions, especially the difficult ones that went to Jen. If you left your name when you were asking a question we didn't get to, we'll try to follow up with you directly or speak to your Fidelity contact. But from all of us, for now, goodbye.